Yo, what's up guys? It's Johnny back with another video for Swing Trading School. In today's video, we're going to talk about risk management and position sizing. This is very, very important, especially with trading. I would say this is more important than a strategy or mindset, anything. Risk management is the number one, priority for your trading, right? Money management. If you're going to be placing how can I explain it? Placing trades in the marketplace, you want to make sure that you're managing your money. It's very, very important in order to actually make money and to not lose more money than you're supposed to. So I'm going to be giving a bunch of examples, what you should be looking for. I'll be giving you technical charts as well to help you out with just, seeing it with an eyeball. And yeah, this is going to be about risk management, position sizing. So make sure to study this and make sure to fully understand this. And yeah, let's jump right into it. So why does risk management matter? Number one, trading is not about how much money you make or just about how much money you lose. It's about how much you keep. That's the most important thing. So one bad trade without good risk management can wipe weeks of progress or can wipe your whole entire account, and you don't want that happening, right? This is not a gamble. This is not like what most of your parents say or your teachers, oh, trading is gambling. It can be if you treat it like gambling, but if you have a proper strategy system and risk management system, you will make money and you'll be able to keep it, which is the most important thing. So how much are you going to risk per trade on your whole account, right? You never, ever, ever want to be risking more than 1 to 5% of your account on one single trade, right? That's going to be called oversizing. Now, what oversizing is literally over leveraging, putting too much than you're supposed to in a trade. You do not want to do that. You want to stay alive in this game. So I think it's very important to keep your risk around 1 to 5%, obviously depending on your account size. The higher your account size is, the lower you keep your risk. If you have a super small account, like $500 to a $1,000 account, you have to realize that, you're going to have to risk a little bit more in order to actually make money. So the next part is stop loss, right? Your stop loss is also one of the most important things, right? You have to place your stop loss in an invalid place where your trade will no longer be valid, right? Which is going to be low of day or negative 20 to 30% of a position, right? Now, what even is a stop loss? If you don't know by now, a stop loss is an area on the chart or an area in your broker, whatever, that you get stopped out of a trade. A stop loss is you stop out of the trade for a loss. That's what a stop loss is. So you never want to risk more than you should, right? It's super simple. Also, you never want to continue to move your stop lower. I see people, they'll have a stop loss, which let's say will be right here. Price will hit their stop loss and they can't accept the loss. So they keep moving their stop lower and lower to, potentially hope for it to reverse to make them profit. When realistically, at the end of the day, that's gambling. It's hoping. You're not approaching trading with a systematic approach when you do stuff like that. So at the end of the day, you want to stick to your stop loss. And if you don't stick to your stop loss, you can have a bigger loss than you usually would want for your account. And that's how you can, obviously not stay alive in the game. Remember what I was talking about. It's very important to just stay alive. What that means is have proper risk management and keep your portfolio at some sort of break-even stage, or even if you are down a little bit, you just want to stay alive. You don't want to blow that account. That's what obviously sets you back super far. Now, the next thing that we're going to get into is risk to reward. What this means is, what are you risking in order to what you're going to get? Are you going to give somebody $1 to make back $1? No, that doesn't even really make sense, right? You can't become super, super profitable and wealthy by having a one-to-one risk to reward. Also, it's just not proven in the actual market, or it's just not something that you can create wealth off of. If you're giving $1 to get $1, you're going to have to do it hundreds and thousands of times. And you're going to have to be right a lot of the times if you have a one-to-one risk to reward. So I think it is very, very important to, at least if you're going to give someone $1, to make 2, 3, 4 back. That is how you can become profitable. So risk to reward, really, it only takes trades where your risk to reward is 2x or more, right? You only want to take trades that are 2x or more. Said that wrong at first, but hopefully you guys understand. You never want to take a trade that's just going to give you something back that you put in. You want to make sure that you're positive on your risk to reward, right? So let's give an example. If you are risking 500, you want to make 1,000 plus on that. You don't want to risk 500 to make 500. That wouldn't really make too much sense, right? So always make sure that you're aiming for about a 1 to 2 RR, which is a risk reward, at least, right? Usually with swing trades, we're aiming for way more than that, even a 1 to 3 to a 1 to 10. That means that you're risking $1 to make 10. You're risking $1 to make 4. Does that make sense? So it's a positive risk to reward. Make sure you pay attention to that. Now, the next thing is position sizing. Very, very important as well. You want to size your contracts so that if your stop loss hits, you lose a certain risk planned, right? That's a very, very, you know what I mean, like serious thing. You don't want to just go into a trade that you don't even know what you're really risking on. It wouldn't make sense. So you want to go into a trade knowing exactly how much percent you're going to be risking. So let's give an example that I wrote out, right? If you're starting with a $1,000 account, right, your first rule is to never put the whole account into the trade. That's just simple as that. If you have a $1,000 account, you should not be putting $500 to $1,000 in per trade. Because let's say if you end up fumbling that trade, or let's say it gaps down, or it goes lower than, you know what I mean, you wanted it to, you could lose a big chunk of your account, and you do not want that to happen. So it's very good to obviously put in little by little into these positions as your account is small. So let's give an example. If you have a $1,000 account, you only really want to use 20% of your account to go into the trade, which would be $200 for one single position. You know what I mean? You never want to be putting a bunch of positions on that's 200, 200, 200. That means you'll be full porting. Full porting means you're putting your whole entire portfolio into a trade or into trades, which you do not want to do, right? So usually what I like to say is put 15 to 20% into a trade of your account. I think that's very important. This automatically protects you because even if something does go insanely wrong, obviously the most that you're exposed to losing is that $200 and not the full $1,000. So hopefully that makes sense. Now inside the $200 position, you still control risk tighter. You're not putting in 200 thinking you're going to lose 200. Right? You still want to allow yourself to lose littler than 200, which obviously when you're in a position with $200, the most you usually want to risk on a position is around 20 to 30% negative, right? So what is 20 to 30% of a $200 position? That's in between 40 to 60 bucks, around there. Now, what percent of your account? If you have a $1,000 account, 40 to 60 bucks is around 4 to 6%. That's like a perfect amount to lose. If anything, you don't even want to lose that. You usually want to lose like 1 to 3%, but if you do have a smaller account, you got to be a bit more lenient. So I do think around the 4 to 5% loss on a trade or on your account, is the best, which would be 20% of the position. Hopefully that makes sense. Really study that. The math is hard at first, but once you get it down, you'll be super straight. So let's say you buy $200 worth of contracts. If your stop loss and you lose, let's say you lose 25% of the position. Now you're down 50 bucks, right? $50 of your $1,000 account, 5% risk. That's the most you can lose. You should be done for the day. Give it up. You know what I mean? You take your loss, you accept it, and you move on, right? So having that plan, make sure that you're never blowing up on your account or on just one bad move, right? Because one bad move is going to happen. It's inevitable to just win every single day, all day, every week. So when you do have these bad days, you want to accept them and understand that these little losses should not matter, because when you have a positive risk to reward in trading, one win can make back a couple losses. That's why you want to have a positive risk to reward. So let's give an example. Let's say you're down, how can I explain it? 20% on a $1,000 account, right? What is that? That's 20% of a $1,000 account. That's 50 bucks? No, that's around a little less, right? So around, let's say you're losing 50 bucks on a trade. You don't want to hold it and let it go all the way down to negative 40 to 50%, because then you're losing a bigger chunk of your account. So that doesn't give you too much room to, you know what I mean, make that back with one win. So you want to minimize your losses as much as possible. I think that's very, very important. Now, the mindset part of this stuff. Risk management is boring. Risk management sometimes doesn't feel the best, right? Sometimes you may get stopped out and you don't want to stop out. You feel like it could go higher. You want to average down into the trade. That means that, you know what I mean, the trade goes down and you're down money, so you keep putting more money in to bring your average down. That means you could obviously, you know what I mean, potentially make more money on a bigger move up. When you don't want to do that, because that's just putting more risk onto the table. You want to make sure that you're accepting your losses, and doing that will separate, obviously, you from a gambler to then being a pro trader, right? If you want to be a professional trader, you need to act like a professional trader. You need to have a system, and you need to treat this like a business. Don't treat this like a gamble and just hold a trade, right? Your job in trading is to just survive. That's all it is. That is literally all it is. So let's get into the charts and let's get into some risk management on the charts. Like I said, it's very important to just go in with, let's say, 200 bucks. So I want to give an example on the stock UNH today. So I took this stock today and we're up pretty nice on this. And I just want to give an example on how you could go about your risk to reward, which is very important. So let's just give an example. You guys already know what a breakout is, right? So you can see on United Health Group, we made a big move up. We pulled back to the 10-day moving average and started consolidating, right? That's exactly what you want to see with these stocks in order to actually see a breakout. You can't just take a breakout that goes up and up and up. That's not a breakout. That's just a rally, right? We take the move after it goes higher and then pulls back, and then that's where we're looking for that move, right? We're looking for that next leg up. You guys already know that, obviously, from watching previous video, which was the breakout strategy. So you know that after a big move up, we wanted to pull back and die out with volume, right? We wanted to start getting thin and start consolidating, because that consolidation is just setting us up for that next leg up, right? You can see we've been consolidating right here on this 10-day moving average. And then what happened today, we ended up breaking out of this area and going higher. I took this trade, and I'm going to show you why I took the trade, right? So you can see, what is our entry criteria? You guys already know this, right? It's a break above our level with a 5-minute close. That was my entry today. You could see if we put this red line right here on the previous day high. And also, what if you don't know what a previous day high is? It's literally the previous day's highest point in the day, right? So what is a previous day? This is today, right? You could see this was today. The previous day was, boom, this day. The highest point in that day was right here. You could see literally right here, these highs. That was the highest point. So if that's right near breakout level, you can see if we draw it, what we want is for it to get above that high for us to get that confirmation. So if we scroll in real quick, and you can see, let me delete this. See how we got above this high? And this is right at market open, mind you. So market opens, the first 5-minute candle, super bullish, bang, closes right there. That's exactly where I entered. Stop loss goes to low of day. Now that is what you're targeting, right? So already today, we targeted obviously a 1 to almost 2 risk to reward. And that's if my stop loss was down there, which most likely it would be. So you can obviously see that's a 1 to 7 risk to reward. Obviously, I didn't even take profits on this yet because I'm targeting this high all the way up here. Would make this a 3R, right? So you can see we would be risking 1 to make 3. And that's exactly why it's very, very crucial for you to hold your position and to not just trim at a quick 15 to 20%. Your first trim should be around at least 25 to 40% in profit. And also, you shouldn't be paying too much attention to percentages. You should really pay attention to just your targets and just focus on where you're targeting. And if those highs get hit, that's where you're taking it off. But usually your first trim, which means you're trimming your position, right? So this is big with risk management. You have to understand, you need to trim positions, right? We're not entering with $200 and then we're up 40%. You're not trimming that whole 200 bucks and taking it off and leaving the trade, right? You're trimming the position, so you're taking a partial off of that position. What that means is if you have 2 contracts and your first TP is at 40%, that means you're going to be taking 1 contract off right there, and you're going to be leaving 1 to keep running. Hopefully that makes sense. So you could see the breakout on United Health Group. You can see if we would have entered on this 5-minute candle close right here, bang, we're entering with 200 bucks. We're given an example if we had a $1,000 account. Realistically, we're risking 20%. So let's say this is 20% right here, and then we're obviously targeting all the way up here. So you can see if this is 20%, you want to make sure your trade is at least going over like 50 to 100%. Because if you're losing 20% on a $200 position, what is that? What is that? 40 bucks, right? So that's 40 bucks of $200. If you're going to lose 40 bucks on this trade down here at negative 20 to 25%, you want to make sure you're at least making over 100 to maybe 150 bucks. So that is exactly why it's very important when you are taking that first trim to not trim too early, because that will actually bring your risk to reward down. So I think it's very important for you to hold your trades as long as possible, right? Set your targets at around, 30% to 40%. I genuinely think that's the best spot to take off your first partial, even maybe higher than that. If the stock is continuing to rip, let it rip. You don't always have to take TP off just because you see green. That's people's biggest mistake. They think just because, trade is turning green, that they can take their trades off right away and they're good. You know what I mean? That's not really how it works. You want to make sure that you're having a systematic approach with your risk management. So let's say if we were targeting this high right here, up here, right? So we're targeting this high, we're targeting these highs, targeting these highs. These are going to be where you're trimming off at those spots. So you can see we broke out. Let's say, obviously that's pretty quick for a TP, but let's say this is our first target, this high. You know what I mean? Let's say we're up 40% up here. That's going to be your first target, your first trim. Now, me personally, when I'm taking my trims, I'm usually trimming 20 to 25% when I take my first partial, around 30 to 40%, around there. So my first TP, I'm normally taking off 25% of my position. That means if I have $1,000 in this trade, I'm taking off $250. That means you can go on ChatGPT or Siri or Google, look it up, you know what I mean? Look up what is 25% of my position. So let's say if you have $450, you can look up what is 25% of $450. That's $112. So take off around 100 to 120 bucks of that position. Who knows how many contracts that's going to be? Obviously, you have to figure that out with your position. But usually with my first target at around 40%-ish, 30%, you want to be taking off 20 to 25% of your position. That's personally just how I like to do it. Everyone has their own systematic approach with their risk management. That's just what works for me. And then my next TP, usually after that, is around, let's say, the 60 to 80% position or mark in your position. So let's say when you're up 30 to 40%, you want to make sure that you're taking off that initial, you know what I mean, move. Like that initial move up, you want to take off some size. You don't want to just hold a trade forever and get greedy. You want to make sure that you're obviously trimming your position and taking some profits off. So let's say if I had $1,000 in this trade, you take off 200, 250, and then when it gets to about 80 to 90% around that area, it's not going to be perfect every time. Remember, the simple trading is the best trading. You know what I mean? You're never going to be like picture perfect. I feel like the people that try to be perfect in the market will get like washed out. You know what I mean? The market's not perfect. You're not going to be perfect. Just make sure that you're taking your profits when you're supposed to. It's simple as that. Set targets. If it hits your target, take off some and trim your position. So let's say when it hits that 80 to 90% mark in your position, right? You're going to take off another, let's say 15 to 25% of your position, right? So you see how you're trimming in increments. You're trimming 20% here, 20% here. That means if I trim 25% at my first TP and then another 25% on my second TP, how much do I have left in my position? Half of my position, right? Because I already trimmed almost half of the position already. That means if I had a $1,000 account, or position size, I would have $500 left in that trade. And then my next trims are at my next targets, maybe in the high 100%. So let's say if the trade is running to 120 to 150%, bang, that's when I'm trimming off another. You know what I mean? You could trim off lighter, maybe 10% of the position, maybe even another 20%. And that's how you're going to be trimming your positions. That's how you're going to have good risk management, and you're going to continue to trim at your targets little by little. And then obviously you're going to want to trail your stop. Now, we will make another video on that. I'm not going to talk about trailing stops in this video, but you do want to trail your stops after the price is continuously moving higher. I think that's very important. You shouldn't just hold on to a trade forever because remember, stocks do not go up forever. There's going to be breakouts where, like, let's give an example, NVTS, right? It breaks out and then it starts pulling back. What if this fails and goes down here? That's a failed breakout. It's not just going to go up forever. Remember that. So you always want to keep a trailing stop and always make these trades risk-free. What that means is, let's say if you're up 50 to 100, 200% on a position, you want to make sure that your stop loss now is either a trailing stop loss in profit or at break even. That means that you will not let your trade go back into a losing trade. That means if it pulls all the way back to your entry level, you're exiting the trade and you're taking the profit that you got and you're leaving it alone, right? You don't want to hold a trade forever just hoping for it to go up. That's just guessing and gambling. We don't do that. Like I said, you want to have a systematic approach and you want to have a plan with every single trade that you're buying. So it's very, very simple, right? Now, risk management, when you are entering these trades, like let's give an example on the stock Tesla, right? I took this breakout. This is a really good breakout. You can obviously see broke out of this super, super tight wedge right here. You can see Price was consolidating for a really long time, got super tight right here, blasted through with a lot of momentum, right? So you can see that's exactly where I took it. Now, let's give an example where my stop loss would have been. And I want to show you the risk to reward on this, right? So let's say I enter the stock right here. As soon as I see that like move up, we did have a 5-minute close on there, but it's pretty extended all the way up here. So you see the pullback and then you see it rip. Bang. Let's say if you enter right there, your stop loss is right here, for instance, because obviously your stop loss usually wants to beat a low of day, but this is way too far. So it can't be at low of day. If it's not an opening range break, it has to be maybe like right here, back under the breakout range, right? So let's say this is negative 25% right there. Now let's see how far the stock went up. Right, let's see if we were targeting this and we drag this all the way up, let's just say to this high, and go to the 15-minute time frame, you can see on this trade, we risked 1 to make 17. And you're going to look at it right here in the very middle. Risk/reward ratio is 17.6. That means that I risked a $1 bill to make $17 on this trade, technically, on a position size like this. Obviously, you're going to be trimming on the way up, so it's going to lower your risk to reward, but you can obviously see if your last, target was all the way up here when you're selling, that is a 1 to 17 risk to reward. And if the stock went that high, let's say, if you place $200 on that and it goes 500%, who even knows how much that is? I can't do the math in my head, but you can obviously see like you're making a lot out of that. That's $1,000. You'd be making $1,000. I don't know why I didn't know that. Wait, right? $1,000? If you put $200 into the trade, if I put $200 into a trade and it goes 500%, how much would I make? Maybe I'm actually dumb. Yeah, $1,000 profit or something like that, around there. So if you're losing 20% on a $200 position, you're losing what, 40 to 60 bucks. But if you make money on that and you actually let it run to 500%, you should make at least around 500 bucks to 1,000 bucks. So that's why it's very important to let your trades run and for them to really play out. A lot of people sell their trades too early, and I think it's very, very important for you to actually hold your trades. Now, the next thing that I want to get into is the moving averages, right? The moving averages play a big part with my risk management plan and really what I'm looking for inside of a breakout. So let's give an example. On a stock like this, let's say that we bought right here in September. Let's say if we bought a month out contract, that means that we would be holding this until it breaks below the moving averages. So the trailing stop for me usually is below the moving averages. Anytime a stock goes up, and if it's still holding above the moving averages, even if it does chop or go back and forth or pull back and I lose a little bit of profits, I'm most of the time always holding my trades as long as we're above the moving averages. Now, I want to give an example of a stock that actually closed below the moving averages. So if we give an example on the stock, where was it at? Rocket, right here, right? So let's just say this stock broke out. It obviously doesn't look like a good breakout, but let's say it broke out right here above the moving averages. Started breaking out, started ripping. Let's say you're up 100%, and then you can see, bang, this day it closed below the moving averages. You would have been out of that trade. You do not want to hold any trades that end up going below the moving averages, because when you do that, you're only just guessing now. You can see when a stock is above the moving averages, it's bullish. Remember from last video, when a stock is below the moving averages, it could turn bearish. So if you do see a closure below the moving averages, you want to make sure that you're exiting your runners and you're staying risk-free on that position and you're taking your profits. There's no reason to hold and hope for it to just go back up. You always want to cut that, because if it goes below the moving averages, look what happens, right? You could see it could easily just trend down and you could lose a lot of money, and you don't want that to happen. I think that's very, very important. I want to go over one more thing on the breakouts and what you want to be paying attention to with risk management. So you can see on the stock RR, we had a breakout right here. Obviously, if we are taking this on this day, you could see we would have taken it around here, stop loss back inside the range. And as of now, from these highs all the way up here, I am up a 1 to 10 risk to reward. Look at that. So I'm losing this to make this. I hope this really makes sense to you guys. When you are trading your breakouts, remember, it's very important for you to realize you need to hold your trades as long as possible. You should not be selling super early or selling on this day. It's always important to watch the moving averages on like a 4-hour to a daily time frame. If you can see, this stock kept riding the moving averages. What I like to say is the stock is surfing the moving averages. So if the stock is continuously surfing the 10 and the 20 day, you want to make sure that you're holding that. So when a stock is surfing the 10 and the 20 and holding above that, that's how you know that the price is currently bullish and that you want to hold it. Let's give an example on RR right here. Look, so we ended up breaking out, looked really good, but then look, started breaking below the moving averages. See how it's losing its momentum and it started breaking these moving averages? That's how you know to look, be out of the trade, because look, it just ended up chopping, and there's no reason why you want to sit in this bull crap. You want to make sure that you're watching the moving averages. It's very important. Now, the number one time frame that I'm looking at is usually a daily time frame. If it does not break below the moving averages on a daily time frame after you take your breakout, it is still considered bullish. So always make sure that you're watching for a candle closure below the 10 or the 20 on a daily time frame. Very, very important. Some other stuff that I want to talk about risk management with like a psychological standpoint on it is this is why a lot of traders blow up, right? Because they don't stick to their risk management plan, they go against it, and they actually don't stick to their stop losses. So remember, you want to have around a 20 to 30% stop loss on these trades. If you're losing more than 20 to 30% of a position, you're risking way too much. Now, it makes sense if you're going into a stock with lighter size. So let's say if you have a $1,000 account and instead of putting $200, which is 20% of your account into a trade, let's say you only put $100 into a trade. That means you have a little bit more room to risk. So instead of a 20% loss on $100, how much is that? That's 20 bucks. That's only 2% of your account. So you have, you know what I mean, a little bit more room to risk on that. You can hold the trade for maybe 30, 35%. But also, another thing, you don't want to be holding a trade when your stock is invalid. So the low of day system is very, very important. You do not want to hold a trade after low of day. Now, let's give an example because some of you guys might not know what that means. Let's say you see a big move up and you see chop right here. Now, let's say you see the breakout. Let's say the candle opens right here and this is low of day. And it starts breaking out. Where's your stop loss? You know what I mean? Low of day, which is right there of this candlestick. Let's say it starts breaking out, but you're up 10% and then it starts failing. Bang. Your stop loss should be negative 20% if your entry is right here. Your stop loss is at low of day immediately. So if we give an example on UNH, it shows you if it broke today below low of day, you should have been out. Give me 1 second. Charts are kind of funky sometimes. We'll go on a 5-minute time frame. You can obviously see this was our breakout level right here, because obviously if we go on a daily time frame, look, we did this example in the beginning of the day. So you can see this was our breakout level, right? So you saw in the beginning of the day, in the morning, in the AM session, we got right above that. What is low of day? So the lowest point of the day is right there. That is where you want to get out of your trade. So let's put it in replay mode, and let's say the stock started going up and then it started failing, right? If it ends up hitting low of day, that means that it's way below your breakout level and you do not want to hold that trade. A lot of people hold trades forever and just hope for them to recover, when realistically, sometimes they never recover and you can lose a big chunk amount of your position and of your account, and you don't want that to happen. You want to have tight risk management, you want to stick to a system, and you want to stick to that day in and day out. It's very important to stick to that. Like I said, the main reason why most traders fail is because they can't actually stick to a plan. So I think it's very, very important for you to stick to a plan every single day, stay disciplined, and to understand that risk management is everything. I hope you guys enjoyed this video. This was a little bit about risk management, position sizing, and just how you should be looking at these trades. We got another video tomorrow. We're going to keep grinding. I love you guys. Leave a like on this video. Leave a comment on, you know what I mean, how you're doing on trading, how your risk management is. You know what I mean? Give me just a nice little sentence in the comment section. Subscribe if you're new. Put in the comments like, yo, Johnny, I've been working on my risk management. I totally understand this video. Give me some feedback. Keep yourself accountable and keep grinding. Love you guys. Peace out.